Hi, I'm Justin Lacoste. I'm the president of the Matsu Education Association. This recording is intended to help members understand what is happening with our insurance renewals and what options we have to try and deal with those increased costs. I'll be going through several slides, so feel free to pause, rewind, and review these at your own pace. I want every member to know what MSEA and CEA are doing to try and contain some of these rising premium prices. Ultimately, we need our members to understand how the premium increases will affect them personally before they have to make a choice. The first slide is just basically outlining what we're doing. First, I want to talk about how health insurance works, how renewal rates work, and then what we can do about those higher prices and the timeline for our event going now. So insurance is about essentially reducing your financial risk for your healthcare needs. So if you are talking about a person that doesn't have health insurance, that means every time they go to the doctor or anytime they need medical care, they have to pay for it all out of pocket. You purchase an insurance plan to essentially prepay those costs, and the insurance provider is figuring out how much they think those costs will be for the average person. When it comes to our insurance plan, however, this is a group-based decision. So they take the group and they figure out through lots of actuarial processing and fancy math to know how much they figure the average person would cost to cover based on the average person's care in that group relative to other people in the area and what that price or what the price is for the area in network. So for us, it's about the price of care here in Alaska and primarily in the Matsu and Anchorage for every different type of medical need that is covered in our policy. Now, that policy price can be reduced by the members of our group by increasing our risk. In other words, we pay for the premium, which is a fixed cost. You pay it out of your paycheck 18 times every year, or you pay for the deductible. For our high deductible health plan this year, that's $1,600. And our other risk is your out of pocket. So you pay that $1,600, and then the Primera insurance company will cover the rest of your coverage at an 80-20 share. So they pay 80%, you pay 20% until you get to your maximum out of pocket costs, which again, the high deductible health plan, that's quite high. You'd have to pay up to $7,000 of total costs for your overall care, which is about $35,000 in care. Whereas in the Mimic plan, it's a $500 deductible, meaning you go to the doctor a few times and you hit your $500 deductible. Or, of course, if you go to the emergency room once, you're going to hit that $500 deductible. And then you are paying that 20% copay until you get to $2,000 of max out of pocket. So those are the two things that we can shift in terms of the way our policy is done without touching the actual things that are covered. So the type of care that is covered by the insurance company. And that's kind of what we're focused on in this effort. Now, insurance renewal rates are based on a few things. The main one is any changes to the plan. So if for some reason we said, from now on, we're going to have unlimited chiropractic adjustments and unlimited massages for our policy, we would end up seeing a rate increase because those are not free. And if Primera has to cover it because that's what we agree upon, then they are going to have to cover their costs for paying out for those claims. Some changes are things we elect. So our plan is pretty robust. It covers a lot of different care. It doesn't cover every type of care. But some changes are not up to us. So things that change by law. For example, this year, the change in the high deductible health plan deductible rate is jumping from 1,600 to 1,650 for the individual, and going from 33, or sorry, going up to 3,300 for the family. If we're talking about other costs when it comes to the renewal rate, it means your claims. So it's based on what your claims are. So if you are paying your premium and your premium was $30,000 for the entire policy, and you actually had $35,000 in claims, then the insurance company would say that they took that loss depending on what your max out of pocket is. So if you're in a Mimic plan and your plan costs $32,000 and you had $35,000 in claims, right? You paid $500, then you paid another $1,500 to hit your max out of pocket over the next amount of time. And so your total usage was about $34,000. So Primera made $1,000 that year. Then they have to figure out the next thing. So in that particular scenario, that one person did not overshoot the estimate that Primera had per individual. They were right around what they assumed it would cost. However, medical inflation is based on what they project the next year worth of healthcare costs being. For next year in FY26, for example, Primera is estimating that it will cost 9% more for the average medical procedure in the state of Alaska. That we can't control, and that's an estimate. And then those are some of the risks that the insurance company and we take. These are the changes to our plan this year that are outside of our control. Teladoc Health is being added for those people that have long-term chronic conditions. So like say diabetes or heart disease. There are things that Teladoc will offer to get you training without having to go to a doctor and pay a full doctor's visit payment for, or teach you how to use a device like a blood pressure cuff or glucose test strips instead of going to your doctor. And some devices are actually free. Next are these diagnostic breast exams. That's not under our control. State law changed. And so that's essentially a supplemental thing that is covered with no cost to us, but it does, of course, require the doctors to bill Primera. And so Primera's costs will go up because of that. For every person that goes and gets that diagnostic breast exam, Primera is going to get a bill. We won't get a bill. And it does not affect our HSA eligibility. So it's something that's an increased benefit to us, but it's going to be an increased cost for them. So that's part of the reason why the rates go up. And then EviCore, the utilization management for outpatient. This won't affect a lot of people, but we do have people every year that have surgeries. And when they have surgeries, a lot of times that requires some outpatient rehabilitation, either with a physical therapist, an occupational therapist, or a massage therapist. And now, if they are doing those therapies based on their rehab for injury or for surgery, they have to get that pre-authorized. So again, it's more of a cost savings for Primera, but the long-term effect is it would keep our rates down too. Prior authorization would not be needed for, say, chiropractic massage, though. When it comes to the premium comparison, we have to look at what we paid this year and what we would pay next year. And so based on our usage, based on the plan's changes, and based on the inflationary rate of medical costs, the district was notified by Primera that the Mimic plan would have to increase by 23.4%, and the HDHP plan would have to go up by 9.5%. That's a huge number when you look at this, when you spread it out over 18 pay periods. You have to remember that for our negotiated agreement this year in FY26, we share that increase. And so that increase being 23.4%, essentially we cover 12% and the district covers 12%. And then for the HDHP, however, we negotiated a 90-10 split of that premium, the total premium, not just the increase. And so the total premium is going to go up to $27,000. And so that increases our contribution from $126 per pay period for 18 pay periods to $151, or only about a $25 increase per pay period. Now, why is that important? Well, it's important for us to look at, and we're narrowing it down to just any changes we could do to the Mimic plan, because the majority of our members are in the Mimic plan. As of March 31st, MSEA had 58%, or almost 600 members in the Mimic plan. And so the majority of our members are going to be affected in a big way when you talk about going from $220 to $426, or an additional $206 every pay period for 18 pay periods. If this helps, some people find it easier to look at a spreadsheet to understand how those numbers look versus charts. So if you're looking at the Mimic plan here, this current school year, it just cost under $32,000 for that policy, and it's jumping up to $39,000. The increase is $7,400 split both ways. That means $3,700 is covered by the district, and $3,700 goes to the member, which drives our cost share up from $3,960 to $7,674. Now, This number 3960, you have to remember, was negotiated by us in our contract negotiations for 2 years. So we started off in FY24 with that amount. We finished off in FY25 with the same amount. So even though the policy went up, you can see here the actual district contributions went up on this next slide. In FY24, it was 28,426. In FY25, it went up to 31,000. So the district had to absorb all of that cost last year, but our members didn't have to absorb any of it. But the 23% increase is on the new premium this year. And so 23% increase means it's a $39,000 price tag on that premium, which is quite a huge increase over the years when you look at it. And then what does that mean for us? Well, the main factor in insurance renewals is your usage. This is why the district wanted to know our data so that they understood that they were getting medical coverage and premium payments, or sorry, claims payments out for the amount, at least the amount that they were paying in or close to it. Of course, we're talking a nonprofit company, so they're not trying to make a bunch of money, but they do need to stay solvent. And so when they see numbers like this, where we have a $5 million excess in claims over payments, that's a problem for Premier. They lost $5 million by insuring those mimic employees this year. And here they made 4 million back on the HDHP, but it all balances out because we're insured as a group. And so, we still had a loss of about $1 million. So then what can we do? We can't control the rates. We can negotiate the rates, and the district did. Originally, they wanted it to be closer to 26% in order to meet their actuarial numbers, but they did agree to drop it down to the numbers that we just talked about. So what we can do, the things we can control is a change in the deductible or a change in the max out of pocket, your risk on top of your fixed cost to lower your fixed cost. So what this means is legally, our e-boards have to negotiate a memorandum of agreement to change our insurance portion of our contract. And by our policy and constitution and bylaws, it's our e-board that makes that decision. Our e-boards got together and decided that it was probably best to be transparent with our members, so it's not a big surprise. And so that's why we're getting this information out to you now, and we're asking you to vote so that you can advise our e-board on how to negotiate with the district for an MOA that may change the mimic plan to reduce the cost of the mimic plan coming out of your paycheck. So we can either increase the deductible for the mimic, which means you're going to pay a little more or a lot more before Primera starts to pay out at that 80% rate. Or you can increase the max out of pocket, which means you continue to pay 20% as you go, and Primera covers 80% until you hit a certain number, and then Primera starts covering everything in your healthcare that's covered for the rest of that year. Essentially, it's shifting costs. You're reducing your fixed costs, the amount that has to come out of your paycheck, whether you use your insurance or not. You got to pay for it. And then you increase your cost if you use your insurance. So there's things you have to look at when we're going, but you got to know this is what we're voting on. We are talking about 3 different options for the mimic plan. The HDHP is going to stay the same because it's going up $25. The rate's going up 9% versus 23% for the mimic. It just makes sense that we focus on the mimic, minimal amount of changes, so our members are not overwhelmed with the options. So we're going to look at changing. Now, you don't have to change. If you vote for the current plan, that's option 1. We keep the $500 deductible and $2,000 deductible, but you're going to pay that exact price right there per payment, which is, again, about $3,700 more than we paid last year, or about $76.75. Or we could increase the deductible by $250. So instead of you paying for, let's say, the first 3 or 4 doctor visits, you're going to pay maybe the first 4 or 5 doctor visits, and then the insurance will kick in, and you would have to pay 20% until you get to a much higher maximum out of pocket. So that's, again, your risk. You may or may not go to the doctor that much. So you may or may not pay $4,000 of care at that 20% rate. But your fixed cost goes down by $55 a paycheck, or nearly $1,000. And the other option was $1,000 deductible and $3,000 out of pocket max. And that one reduces your cost only by $50 or $900. Um, or sorry, or you to save $900 versus being in the current plan. Now those come with risk, like I said. So the $750 deductible would increase your deductible by $250 or $750 for a family of three. And the $1,000 deductible would increase your deductible by $500 or an additional $1,500 for a family of three. And that increased amount that's being paid out is why Primera can charge a little less. These are some employee scenarios that are intended for you to look over. This first one is so that you can see what the three plans would look like if you had $10,000 worth of claims. That means that you went to several doctors or you had a one-time uh, procedure that cost $10,000 at one shot. We do have those. Perhaps you've experienced that in emergency room care. Or it could be that you went to the doctor several times, or you had some procedures done that were outpatient and whatnot. It added up to $10,000, and so these are the total costs. If you met your deductible, paid your 20% here, up to an additional $1,500 or $2,000 total out of pocket. So your total price for your insurance or your healthcare that year was this amount. If you were to increase it to $750 deductible and a $4,000 out of pocket, your price of coverage went down. Even though you had the same exact medical needs, your price was about $400 cheaper on the year, and here your price was about $100 cheaper. The next two slides I'm going to let you go over, but it's for an individual that had a large usage year, $25,000 in claim. Don't get me wrong. There are people that have had $250,000 in claims, but this is more for the common person, and you can see how that affects you, whether you've met your deductible and you've met your max out of pocket. And we also added the HDHP just so people that are in the HDHP and are considering moving to the Mimic can kind of see what those costs could be different for them. This one is for a family that had $57,000 in claims. Now you need to understand the timeline. The reason why we're pushing this out so quickly is we just got the renewal rates, and we do have to get this going as quickly as we can in terms of our negotiations for a memorandum of agreement if our members want that. And so the vote is going to happen on April 21st through the 25th. And so that means next week. You should get an email. It'll either be titled from MSEA, or you can search your inbox for Election Buddy. That is the system that actually runs the digital vote. Before you vote, it would be wise for you to review your personal or family claims data on the Primera website. I'll explain a little bit more of that in a minute. And then you can calculate what you think your spending was and what you think your spending will be, determine if this is a normal year for you or an abnormal year for you. And then you'd be ready to vote on which option you think would be best for you, or if you're not going to be in the Mimic, what you think would be best for others in the Mimic plan. And then the following Monday, April 28th, till whenever the negotiations take as long as they take. MSEA and CEA are going to negotiate a memorandum of agreement. Why are we doing it together? It's because we have two plans right now. We're the only groups that have those two plans. And so it's up to, we can't spread them out and make different plans for each bargaining unit, or else those costs would go up again because it's more expensive for Premier to manage. And then after the MOA is signed, Primera will make the necessary adjustments to the plan costs, and we'll get those plan costs out to you. And then the open enrollment period begins. Now that open enrollment period can change from, the May 19th through the 30th to maybe May 9th through the 30th, depending on how long it takes for us to get the MOA signed. But by July 1st, the insurance plan will take effect. And so we have to have this done in time for that. So this is how you check out the Primera website, log in, go to claims, then click manage claims. Then once you get to that page, click filter, which is on the right-hand side, select the date range you want. I chose this date range because it made more sense to me to just have one deductible to factor in. And then after you hit apply, you click download claims, and it'll give you an Excel spreadsheet that kind of shows you what your claims were, how much Primera paid, and how much you paid. So your claims are the first thing you need to look at. If you had $10,000, $30,000, $100,000 in claims, all of that changes. And if that's a normal year for you, then you can expect to do that again next year. And that's how you figure out which plan is best for you based on the cost. And so the first one is your claims, then you look at your cost. And if it says your cost was $5,000 of total, cost, then you have to factor that in with what the price was of the premium. After the vote, that's when it's time to really educate yourself. And so we're going to, once we get the information out to you about what was the final decision with the MOA process, then those costs will be shared with you. You'll understand what the price is, any changes to that, any changes to the plan, and then how those will impact which plan you feel is right for you and your family. But in the meantime, you can be checking the district's payroll website and look at their coverage. So simply, you just go to the district website, go to payroll, click on retirement and benefits, scroll down till you get to the medical and dental benefits, and then click on the high deductible versus the Mimic health plan and compare and contrast those two. They are different. While a lot of it is covered the same, there are several things that are not covered on the HDHP. And if those apply to you, if you think you're going to use those, then it would be important for you to really review those costs on yourself and your family. In what is not covered, it may change you to want to be on the Mimic plan. What else can you do? You need to stay informed. Please look for emails from MSEA. And in the meantime, if you have questions, please, our building reps got some basic training on this. They've looked through the slideshow and they can kind of help you understand more about this. Otherwise, you can reach out to me at msea@mseak.org, or you can reach out to Jennifer Dahlquist, who is the Mat-Su School District Employee Benefits Coordinator. And she has a lot of good information, especially when it comes to how to navigate Primera. All right. Remember, we're in this together, and I really appreciate your time today.